Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is February 27th, 2025. And today on our call, we have the CEO, Cameron Groome from Microbix Biosystems. Microbix trades on the TSX exchange under the symbol MBX, and it also trades on the OTC under MBXBF. The company is currently trading at 44 cents with about 142 million shares outstanding, or about a $62.5 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Cameron, great to see you.
Thank you.
It's been a little while, but happy to have you here with us today. Microbix is a story that we've known, or certainly I've known for quite a while, and you guys have seen some significant success and sort of milestones met here over the last couple of years. There's a number of members here that do know the story, but there's also a number that don't know the story. So I know you get a presentation deck that you're ready to go with, but let's remind everybody what Microbix is all about.
Okay, absolutely. So our company is in the field of life sciences, and we principally enable medical diagnostics to actually be manufactured and make certain they work. Oftentimes we get pulled into the healthcare system, and there's a first question is, doctor, what's wrong with me? And that's where these medical tests really come into play. And if you get a timely and an accurate diagnosis, then oftentimes healthcare system isn't so bad. The challenge is getting that diagnosis quickly and accurately, and not having false negatives where they don't pick up a disease you do have, and not having, God forbid, false positives where they tell you you have a disease that you don't actually have. And we're all about making sure tests can be built. That's our ingredients business. And then the tests actually work. And that's our controls business. And by doing so, we're supporting the effective use of a lot of these next generation diagnostic technologies. And we'll talk about why and where that is. And that's driving some real growth in revenues for us, and also in net earnings. And yes, we do have net earnings. We are a profitable company, and we're actually buying back shares rather than running around looking for more money. So that tightens up the float and makes everybody's ownership stake that much more valuable, as we're prudently able to do that.
That's perfect. That's perfect. Well, let's get into some of the updates then. What's been happening over the last little while? Why are you growing? And obviously happy to see that you're making money. And what can investors expect sort of going forward in that regard?
Well, some of the things we've been doing, we're somewhat conservative in our demeanor, in that we don't yell loudly about things we haven't done yet the moment we have had the thought. We announce things we've completed, and projects and achievements that we've actually executed on. And that's, perhaps a slower road, but it's a much more comfortable and certain one from investors. So we've been working and we've been expanding the addressable markets in our test ingredients business, and we can go into a little bit more about that, and also in our test controls business. And we've been adding different product categories. So new classes of test ingredients that we're starting to be able to make, and moving from our traditional focus in the infectious diseases test field to adding tests in areas such as oncology and genetic disease as well, very quickly in that. And we've also been continuing to upgrade our regulatory accreditations, which ensure that we continue to have access to important markets like Western Europe and growing our sales into other markets such as Asia and the Asia Pacific regions. So we're now exporting. We have access to more than 30 different countries internationally, and we're seeing, increasing revenues in those areas, adding customers and selling more to each existing customer. So a lot of fun. We're likewise starting to get noticed. If anybody surfs the news wires, you'll see I've got a little nice, Ontario Trillium pin in today. And that's because we had Premier Doug Ford, who's out campaigning for re-election, in for a visit today, but just hitting radar screens at a variety of different levels, including the political side of things.
Awesome. Let's maybe highlight some of the financial success you've had recently. Like you mentioned, growing and profitable. Maybe give us some numbers. Where are you as a business in that regard?
Absolutely. We finished our fiscal 2024, and we're on a September 30 fiscal year with revenues of 25.4 million. So through the 25 million mark in total revenues. 4.1 million of those revenues, though, were related to our therapeutic drug program, whereby we have a fully funded program to return an FDA-approved drug to market. So 21.3 million for fiscal 24 was sort of ongoing sales revenues to different customers. And we announced our Q1. This is for the quarter ended December 31st, 2024 in mid-February. And for that quarter, we generated recurring revenues of 6 million. We had a very strong gross margin of 62% that is operationally up from 49% the prior year, reflecting improvements in practices and engineering investments, and a very good net earnings of 856,000 for the quarter, or close to a 15% net margin. And that reflects margin improvements and for gross margin increases due to tighter product practices, and we also have kept a very good lid on our operating expenditures, which were down also year over year. So just, we'd like to represent a well-run company. We closed the reported quarter with 13 million in cash. We have closer to 15 million in cash today, as we also saw at the end of January, the exercise of some warrants from a prior financing that brought in another 2.4 million of capital to the company. So in a very strong position to keep executing and grow strategically.
Let's talk about the cash then. What do you do with the cash in your position right now going forward?
Well, some of it we've been using we continue to have strong CapEx plans for it. And we've been expanding our research and development work as well, more industrial development than discovery research, but what we're doing is very innovative. But we continue to generate more cash than we are consuming. So I think there'll be several instances for use of that. We still do have some mortgage debt on our facility that we may repay. We will continue with aggressive stock repurchases under our announced normal course issuer bid. And, we'll also, now that we have upgraded our enterprise resource planning software and that we're successfully implementing digital quality management systems for production, we're in a much better position to successfully integrate an acquisition. And while we don't have anything currently on the radar screen, I'm very conscious of cash needs to be intelligently deployed. So, your four options are inherently pay down debt, stock repurchases, consider carefully acquisitions at the right price in the right area that where it's synergistic, and hell, maybe one day we even consider a dividend.
Wow. Not too many small companies doing that. That'd be interesting. Okay, so you mentioned prior FDA approved drug that is coming to market. It's Kinlytic. I think there's two names for it. I can't even remember the other one.
Exactly. Kinlytic is the trade name, and
Yeah,
urokinase is the
that's
name
it.
of the product. Exactly right.
Exactly. Maybe give us an update there and what
Yeah.
investors can expect. Yeah.
So Kinlytics it's such a unique case. It really is a unicorn of a program. Um, Kinlytic, under the prior trade name abokinase, was the most successful clot buster or thrombolytic drug on the market in the United States and Canada, and was used in millions of patients to successfully and safely treat pulmonary embolisms, an approved label claim by FDA and Health Canada, and to treat other clots in the body off-label, things like peripheral arterial occlusions, deep vein thrombosis, heart attack, and stroke. Um, it has also been widely and successfully used to dissolve blood clots in biomedical catheters. So venous catheters going into the central vein for long-term chemotherapy, biological cancer therapy, and intravenous nutrition, and also used for long indwelling dialysis catheters that are used. If a little bit of blood backwashes into those catheters and creates a clot, if it can't be mechanically sucked out, then you've got a big morbidity and expense of a vascular surgeon to put in a new catheter system at a cost of, approaching $10,000, and anesthetic risks and infection risks and so forth. So this drug came off the market for a variety of commercial reasons, and Microbix at the time had been considering a biosimilar program to that product, but we found ourselves in a circumstance where we were able to buy the drug master file for that original product that used to sell hundreds of millions of dollars a year. And it was going to be a very large expense to bring it back for all indications, well in excess of 100 million US, which was far more than Microbix could field. So when I was invited in as CEO, we dialed that into the catheter sub-indication to make it a smaller and tighter program. And we've now partnered that out with a portfolio company of one of the most sophisticated life sciences private equity firms in the world. And they are paying all of the bills and will be the drug marketer ultimately. And we're providing the technical support to bring that drug back. And in the US, that's a $500 million a year monopoly right now for Roche Genentech with their tissue plasminogen activator under the CathFlow Activase brand for the catheter clearance indication. And it's our intention to initially bring the drug back for that indication, turn a monopoly into a duopoly, better product, supply chain security, some price relief, penetrate about a third of the dollar value of that, capture about a third of the dollar value of that market quickly. And then we'll look at other clinical indications in other geographies to expand that opportunity further. And Microbix is not having to invest the approximately 50 million Canadian to bring it back for that indication, but we will be capturing further sales-driven milestone payments and royalties on product sales. So potentially this will generate even more net earnings than could be ascribed to our diagnostics business. So we've really got a turbocharger, supercharger with our drug program on the already very strong growth we're experiencing in our diagnostics business.
Mm-hmm. And Cameron, what does the timeline look like? What are you hoping? How are you hoping this plays out time-wise?
Yeah. I mean, for our diagnostics business, we're already growing very, very quickly. And, this past year, we grew organic sales growth on the order of 40%. Now, I'm not going to go and, project that, come in at 35 and have somebody say you missed your guidance. So we're certainly giving a pretty broad range. We'd like to target at least 20%. If we can go, much higher than that and come in the 40%, well, boy, we'll look for some pats on the backs for that kind of annual growth. So that's in the here and now, and that is very exciting. And by the analysts' take, that alone just more than justifies our market cap. The analysts currently aren't ascribing a lot of value to Kinlytic, but have a 90-cent or $1 12-month target price. Kinlytic timeline, Paul, gets more interesting because right now we're looking at reapproval by FDA somewhere around late 2027 calendar, which seems a long way off, but about 3 years. But that starts to get discounted as people see the evidence of this project progressing through to a new filing with FDA. Supplemental BLA is what it's called, Supplemental Biologicals Licensing Application. I believe analysts and investors will start to discount that 12 or 18 months back from approval, and certainly a big rethink when we file that supplement earlier in 2027, probably around mid-2027. So over the next 12 or 18 months, Microbix will not only be recognized as an interesting high growth diagnostics company, but that therapeutics kicker will really start to come into play in people having to value our company from both potential an existing revenue and profit stream and one that's coming up real fast.
Mm-hmm. And can you get a sense of what, like, is there expectations of what kind of revenue you'll generate from Kinlytic on the Microbix side?
Yeah, we've given guidance that we're targeting to have $30 million in sales driven milestones. Those are contingent on hitting those sales milestones, of course. And we're targeting a double-digit royalty on product sales. So, product sales build up quickly. We get a double whammy on the one-time sales milestones plus the ongoing royalties on product sales. And there's great opportunity to expand the geography for the product into Canada, into Western Europe, for example, and to expand the clinical indications as we dial in new manufacturing. Then we can also look at the pathway to bring the product back for some of the systemic indications that use much more drug active substance, such as pulmonary embolism, which still doesn't have a effective and safe thrombolytic treatment right now. So there's very good opportunities on both sides of that.
Mm-hmm. It appears to have a lot of upside.
Oh, absolutely.
Yeah,
absolutely. Wow. Hey, this is why, you see all our management team, and our directors own shares, and we continue to increase our positions. We're not in this for, job security. We're in this to build real wealth for shareholders because we're shareholders too.
Yeah, exactly. That's awesome. Why don't we get this question out of the way? Tariffs. The current business you have right now, all this chatter of tariffs. Any impact on your business? That
it would have an impact if tariffs are directed. There's a few elements there, but if you go through our financials, you'll see in the latest quarter about 80% of our revenues are denominated in US dollars, but that doesn't mean 80% is products going into the US. My best estimate there would be about 30% of our revenues could attract tariffs, but we have never really dialed in. Often we're doing development for people of new quality control products, And for convenience, we've just priced the good and the service together. For example, we're developing new products for you, and you need a validation lot of 5,000 units. We'll just charge you in one basket for the work, and the product is one. But if we actually think about what that allocation is, really a lot of it is service oriented. So that could be readily split off, more definitively and precisely between those value propositions, and probably get that tariff exposure down further. Then there's the issue of, are the products we creating easily substituted by a US based product? And in most cases, they're not. So, it would be our client having to absorb that. There are some products that we make that are somewhat more generic, but that's a small number. So my what I've said to the board, and I'll say here, is I think we might be vulnerable maybe to lose as much as $1 million worth of business, and perhaps if we decide to share a bit of pain with our customers, maybe we take a 2% 2 to 4% margin hit, 2% in the near term, 4% if tariffs really persisted. But what we do is so unique and specialized. It's not like we're selling 2x4s and somebody says, you know what, a 25% tariff, you're completely out of the market. You're done here. For us, this is supremely high-end work. So I'm not going to sit here and say there'll be no impact, but I think it's unpleasant but completely livable.
Gotcha.
Of course, I could be wrong, but that's my best viewpoint at present.
Yeah, there's a lot of uncertainty right now, so I think there's a lot of ability to be very right or very wrong in this current climate. I want to remind everybody that's listening, we are taking questions. If you want to ask Cameron a question, please use the chat function. I see that some have already come in. We'll get to those in a second. Cameron, currently, what are your greatest challenges running the business? What sort of keeps you up at night?
Oh, well, one of the things that always kept me up at night when I came in as CEO was human resources and keeping our people. We've just got such a brilliant and dedicated group of staff, but I think we've got both the corporate culture and the compensation systems dialed in. So, our turnover rate now is about 10% of staff, mostly at the more junior levels. And that is very low I think, for our industry. So that's something we continue to watch. I think the international environment, just general trade barriers and so forth, keeps me up at night. And then it's really a question of not getting ahead of our skis with growth. We've been adding to capabilities of the company massively, and we've been adding to capacity. And we've been doing this while staying profitable, while not, and having an optimal cost of capital. So in the past, 6 or 7 years, we have increased the share count by about 50%, but we've quadrupled the market cap. So, this is the kind of efficient frontier we're riding in managing that balance, and that's something I'd like to continue doing. But, that always gets you thinking about, am I too early in building the next, or in having our team? I shouldn't say me. It's I'm a small piece of this, but when do we build the capabilities? Are we too early or too late? And it's trying to judgment call between those two.
Yeah, no, fair enough. Well, why don't we take a couple questions we've got here?
Sure.
Okay, Curtis asked, curious how much dollar value can be attached to the aggressive share buyback in a year, 1 million, 2 million, or plus. I mean, do you have a standard 5% share buyback?
We do. We have
Yeah.
a standard 5% share buyback, normal course issuer bid in the parlance of the TSX. There are specific restrictions on how much you're able to buy each day. And you can't buy on an uptick. You've got to buy on a flat tick or a down tick. And we're able to react to one block a week. We initially set up the plan at a minimum to offset the use of the rolling stock option plan. We have a standard 10% rolling plan, so we're issuing 2% stock options a year as part of our overall compensation scheme to give some long-term alignment between managers and higher with shareholder interests. The first year we bought back about little over that 2% mark. There were some problems with the dealer we had executing the NCIB was reluctant to do blocks, so that tied our hands quite a bit. The second year of the plan, we bought back, I think, 3-point-something%, 3.3 comes to mind. And this year, I'd like to see us more aggressive still and maybe in the 4 to 5% range on the buyback.
Perfect. Thank you. Okay, so Russell asked, what kind? Okay, we answered this question in regards to Kinlytic. Next question. Rahil says, "Hi Cameron, why does management not buy out convertible debentures to save cash from interest? I assume some of the debentures are owned by management."
No, the debentures were put in place with an expat billionaire friend of our founder years ago. There's no acceleration provision on the debentures. And then you get into some very interesting IFRS debenture accounting, where the value of the debenture is split between a deemed equity portion and then a deemed debt portion that is written up to par during the term of the debenture. So we would take a net income hit if we approach those debentures for a buyback at the present time. But I do have some strategies that I'd rather not go into at a public forum that might enable the retirement of those debentures in a good way. But they're not burdensome. It's $4 million face value, 9% coupon, so it's $90,000 a quarter in interest payment. It isn't even a friction on our P&L now.
Awesome. Okay, Adamo says, "Is there a patent expiration risk with anything that you own?"
No, there's some upside on patent work, but no downside. Interestingly, for Kinlytic, this is such a complex biological molecule, and the regulatory pathways are so complex that even though this molecule was created decades ago, as was the competing TPA, no one in the world has ever successfully created a biosimilar to these products. So it's all in know-how and skills and regulatory pathways. On our own products, we have some tremendous advantages that we own all of our viral seeds, we own all of our cell lines, all our bacterial strains, and we own them all in almost every case royalty-free with clean title. And that gives us tremendous advantages in cost structure, but also in the knowledge base within our organization. If you were trying greenfield or brownfield a Microbix, you'd be looking at well north of 100 million, and it'd take you a decade. So just the skills that we have, the challenge for management is okay, you've got all these skills now, how do you expand the addressable markets and take greater advantage of the skill sets we do have? And that's how we built multiple product lines now and continue to broaden out that work. We do have a patent we're pursuing that I think could be very key on innovative and novel means of making novel, useful, and non-obvious means in patent parlance of making molecular controls. And we're pursuing prosecution of that intellectual property. And anyone that really wants to go down the rabbit hole can find a published patent application around that molecular controls work that we've done. I'm actually humbled to say I'm a co-inventor on that patent, along with some people far smarter than I. But we do good work and some good brainstorming. So there's upside to that
Yeah.
as well, but I don't see us having a patent cliff in the same way that a small molecule would in the drug industry.
Awesome. Very interesting. Okay, next question is from Russell again. It says, is there anything you feel could possibly hold up or prevent Kinlytic FDA approval?
There are always things that can come up, and you can have technical issues. The way we're doing it, this is a drug that's been successfully manufactured in the past. We're modifying, or not modifying, but modernizing different aspects of that manufacturing workflow in consultation with FDA. There are, I think the bigger issues there is, does one of the contract drug manufacturing organizations or contract research organizations that we're engaging for this work, does anyone drop the ball on there? But we're very carefully selecting those partners. We're very much helping them with the technical elements, and we don't see anything visible that should disrupt Kinlytic. But timeline slippage is always a possibility, of course.
Gotcha. Okay, question comes in from Hassan. He says, what's your customer concentration? Any risk around customer concentration for your products?
Always, we fight to disperse customer concentration, but then some of our big customers keep ordering more product from us, and we're growing our business with them. So, it's a fight to disperse that. But we've had new customers rise up that sort of top 5 list and stay there. And we're continuing to look to add, more 7-figure customers into the mix, as well as smaller firms. So we've got, majority of our revenues now are coming from groups in the clinical lab proficiency testing and accreditation areas, from test makers. And then we're getting a growing number of small orders, small but steady orders from different clinical labs that are scattered around. So I think that, that dispersion of customer concentration will continue, but it doesn't mean we're going to walk away from an order from an existing big customer. Sorry, we can't take more business from you because of our customer concentration.
Exactly.
Yeah, exactly. Yeah. It's too much, darling. Too much. No, we're not going to do that.
Yeah. As far as competition, give us a sense of what the competitive landscape is for.
It's pretty thin in that regard. There are hundreds of companies that are trying to develop or have developed a medical diagnostic or two. For us, we're not pretending that an Abbott or a Becton Dickinson or, Cepheid, Diasorin, Elitac, these, I could go down the alphabet. We're not competing with these guys. They're our customers. So the number of companies that can provide sophisticated biological ingredients and controls is much, much smaller. So in the native antigens business, in the ingredients business, there's about 3 meaningful competitors. In the test controls business, there may be a half a dozen. So again, we've been in the ingredients business a long time, in the native antigen business, which is sort of the very high end of that field. And we're adding capabilities in the recombinant or synthetic antigen side now. And that was an announcement in January that we're adding those capabilities and resources. And then in the test controls business, we haven't been there that long compared to some other people, but I think we've really shocked folks with the extent of our innovative thinking and delivering products that haven't, previously been conceived of, and leapfrogging a lot of competitors in that respect in capabilities. So we're winning business from existing customers, and we're winning new business from those incumbent firms that, again, I could count on the fingers of one hand.
Earlier you mentioned M&A. And give us a sense of where you'd want to go with your M&A strategy. Are you looking for new sort of new novel products? Are you looking for capacity? Are you looking for customers? How do we get in your head in terms of what you're thinking M&A side?
Yeah, it's a great question, Paul. We looked at in 2023, there were a couple of businesses that we took a peek at, and we didn't pull the trigger. And there were two reasons on those. One, they were more additive to our business. They had some adjacent product lines, but they didn't really synergize with us. And so that was one reason we didn't end up pulling the trigger. The second reason was we didn't have a good currency in terms of share price or quite enough cash to transact on a cash basis. And the third reason we didn't act on that was we were right in the middle of an ERP system switchover and upgrade. And that just isn't, when you're changing your enterprise resource planning software and getting that all up and running, it would have been cruel and unusual punishment for our team to ask them to try and integrate an acquisition at the same time. So we completely backed off at that point. There are, I think what we'd be looking at would be things that are very much in our customer wheelhouse, that if they brought clients, in the diagnostic sector that we didn't have, and enabled more points of contact and more cross-selling capabilities, that would be interesting. And if we found a company that has technology or capacity in our test ingredients or our test controls businesses, those would be things we'd look at. And then the questions would be, is it accretive? What's the price? On top of that, strategic value. I've got a couple of things that I want to explore this year, but nothing that, we're in a data room or grappling with a negotiation at this side. It's more, what do we want to look at conceptually? And I have a few meetings that I need to schedule in that regard.
Gotcha. Appreciate it. Okay, Rahil's got a couple questions here. It says, how are you using the capacity that was built for the viral transport DXTM production?
Great question. We have excellent capacity for that. What we're looking at now, we've started to use that. Sorry, just to back up for audience that may not be aware. In very early in 2020, we flagged that COVID-19, then the Wuhan coronavirus, looked like it was going to break out as a pandemic. So by March of 2020, we had registered medical devices available to support validation and checking the accuracy of serological antigen and PCR tests for COVID-19. So we were very fast out of the gate there. And then we found that deduced, from our contacts, that Ontario was going to have a heck of a time getting reliable supply of what's called viral transport medium. And what this stuff does, very complex media that takes the swab sample that you snap off and put it in the vial and stabilizes it so that the virus doesn't degrade and before it can be tested by the lab. Otherwise, the amount of virus on the swab after 24, 48, 72 hours would have no relationship to what you originally sampled. So we flagged to Ontario that they were going to have a devil of a time getting reliable supplies of this. And we said, would you like us to make it for you? So they said, yes, please. They gave us a grant to accelerate that work. And we effectively saved the testing system from collapse in Ontario. And they were very generous in providing us 2 grants from the Ontario Together Fund and close to $5 million in orders in 2021 and 2022. And then we brought in some equipment for automated filling. And in 2023, for whatever reason, there's an ongoing disconnect a little bit between the political leadership and the procurement leadership. And they went back to importation. So we've taken our equipment. We're starting to be repositioning that towards different reagent filling opportunities that we've identified, but we'd very much like to get back in a situation where we're at least one of a few core suppliers to the province of Ontario, and that dialogue continues. And you know, judging by our guest today, we're certainly working to build that relationship and fully restore it.
Awesome. Okay, we'll take one last question here again from Cameron. It says, hi Cameron, from Rahil. Hi Cameron, since you were an investment banker in your prior life, what do you think is the true value of the core business, excluding Kinlytic?
You know, value of the tongue-in-cheek answer is of course, you know, value of a business is what somebody's willing to pay for it. Right now, however, I don't think it's the optimal time to shop or sell our business. And we've had, you know, number of people come around that are in the general field or life science tools aggregators that say, you know, how the hell are you guys growing at the rate you're growing at? You know, trying to figure out the secret sauce and also having interest in buying our business. Thus far, that's kind of been a little more of a scavenger strategy for companies saying, gosh, I love what you're doing. We're really hoping you'll stumble so we don't have to pay a massive premium for your business. As we move forward and we fully execute on Kinlytic and we've continued to grow the business quarter by quarter, the more of a track record we have of profitable growth and the more we add in that therapeutics asset, the more the business is worth. And, you know, I'm certainly not doing this for, you know, a 40% premium on 45 cents does not particularly excite us. You know, I think if we're looking at $3, $4, $5 a share in, you know, 2, 3, 4 years, that you know, that starts to be a little more in the ballpark. And at that point, you know, we've built a business that's, you know, $500 million to $1 billion value, and starts to become a real jewel. And if somebody doesn't want to pay a massive premium, guys, that's fine too. You know, the flip side of the M&A, as I've done M&A on the sell side, I've done M&A on the buy side. If we're not prey, we'll be predator. But we're going to do it in such a way that adds shareholder and maximizes shareholder value. And that's what we say, you know, to potential acquirers. We say, hey, you know, we'll engage with you to a point. But, you know, please don't come at us with a proposal that we'll be at within 12 months anyway. You know, if you're willing to look 2, 3 years out in terms of the real strategic value of our business to your larger company, then we've got basis for a real dialogue. So we're just keeping ahead of kind of what people are willing to do. And I think we can continue to deliver some outsized value for shareholders for some time to come.
What do you think this business looks like 5 years down the road?
I'd like to see us at or above 100 million in sales. You know, we should be, well, we're already, you know, we should be around the 25 million mark in organic revenues this year, 25 to 27, somewhere in that range, depending on what jumps into the boat or slips the hook in business wise. And a good chunk of that will also be coming in Kinlytic royalties as well, which is, you know, 100% pre-tax margin as those revenues come in. So, you know, we should have a very profitable business and, you know, some great opportunities as long as we continue with disciplined execution. I think, you know, we can generate some very real value.
Okay, put your investment banking hat back on. If you're speaking to investors right now, what do you think are the sort of the key metrics or key sort of performance metrics that make the most sense to pay attention to?
I think the level of innovation that we're doing, and maybe later, Paul, I'll pull a slide up that just shows the pace at which we're innovating. And we only announce stuff when we completed it, right? We're not announcing stuff when it's, oh, you know, I've conceived of an idea, therefore we're going to put out a news release. No, we'll announce something when it's legitimately completed, and we do a lot. So the level of innovation I think is one thing. The other thing is revenue growth is a key metric, and doing that while demonstrating that we're in control of the business. So, it's easy to grow revenues if you're, you know, losing a ridiculous amount of money in the process and burning shareholder equity. We're doing profitable growth. So we're growing the business while demonstrating we're in control of the business. That's another metric. And I think the other thing is to not lose sight of Kinlytic marching forward, as that has such immediate leverage on the earnings side of things. And how many Canadian companies can say, hey, I've got a fully partnered drug program, fully funded for a drug that's already been FDA approved, and we just need to do the work to validate new manufacturing to bring it back to market.
And then Cameron, you're a life science company listed on a Canadian exchange. What's been the investor appetite of late for that type of company? I mean, traditionally successful companies move to NASDAQ, I guess, but what can you tell us?
Well, I think there's a couple issues. One, we've had a very questionable set of industrial policies at the federal level. And, I see that as diminishing appetite for Canadian public companies generally, never mind life sciences. I saw some statistics that all of the money raised for all of the companies on the TSX and TSXV was $12 billion for the first half. And you go 12 billion, okay, that's $300 per capita. That's it. Reinvestment in public markets for Canada in the first half of 24. And in the second half of 24, it was 3 billion. That's $75 per capita. So that's people in Canada going, whoa, where are we where are we willing to reinvest at present? So I think hopefully that policies are put in place, and we could talk about capital gains tax and any of these other things, but are put in place that are really pro-growth will be a big help. I don't think moving to NASDAQ is the panacea that people believe it is, unless you have scale.
Right.
And for us, to add in, I know we get in a waiver for a time on Sarbanes-Oxley compliance and so forth, but to just move to the NASDAQ, have a whole bunch of fees piled on, a big reverse split and everything, and still have somebody look and say, so you got 25 million in revenues, so what? To me, there's a time for that. When we're cracking in the 50, 75 million of revenues or higher, that's really time where we can get all eyeballs on us on NASDAQ. And I think my personal view is that would be when it's time to do that. And I don't think that's too far away. By the time we do it, then we don't even need to be, talking about reverse splits or any of that stuff as well.
Yeah, exactly. Listen, Cameron, is there anything we missed? Is there any message or anything you wanted to either say or show to the audience here today?
Yeah, I mean, if you look at our investor presentation on our website and take some time to navigate around that, you'll really see just the bench strength we have in terms of the management team here. This isn't, I get to be the spokesperson, and I often pull in our COO and CFO, but there's far more depth beyond that. And, we just have a fabulous team, a talented group of people for a company our size. Like, we are doing leading edge science, driving innovative, impactful products. And that's why you see those financial results coming along. So this is a real operating company. We have 130 staff now. We're operating and engaged with companies and shipping product all over the world. This is real. This is real growth, real sales, real net earnings, and a company that's very investable. And we're committed to building shareholder value. We know what that is. And our interests are aligned with yours.
That's awesome. Well, thank you so much, Cameron. We've been speaking with Cameron Groome, CEO of Microbix, symbol MBX on the TSX exchange. It was fantastic to catch up, Cameron, and we certainly look forward to the next time we can.
Thank you so much. Let's not make it so long between next time, and we'll have I think a great first half and a great second half to talk about in 2025. So thank you again, Paul. Thank you, Trevor, and everybody today for joining us.
Thank you so much. We'll catch up soon. Bye for now.
Great fun. Bye.
Okay, bye.